Passive investments within companies are under scrutiny in the commentary paper. Corporations are generally taxed at lower rates than individuals so that funds can be reinvested in a business to help it grow. When a business is capitalized, an opportunity exists to reinvest those funds in passive investments like portfolio stocks or real property, without first removing the funds and subjecting them to higher personal tax rates. Under the existing taxation, there is a refundable tax applied to earnings of passive investments in the corporation, which is recovered when the earnings are distributed to shareholders in the form of dividends. The commentary paper did not include proposed legislation, but rather a methodology that the government would draft legislation to complete the following. First, remove the refundability of passive investments and rather tax the income at a rate of approximately 50%. Second, align the tax treatment of passive income distributed to shareholders with that of the source used to fund the passive investments, be it shareholder loan or earnings that would qualify for either eligible or ineligible dividends. And treat all income received from portfolio investments as non-eligible dividends and deny the capital dividend account inclusion on gains realized on passive investments. This would lead to passive income being taxed at a high rate within the company and again at distribution, which is a double tax. Without specific legislation, the course of action is unclear, except that passive investments may result in high tax to your corporation and potentially additional record-keeping requirements. Because of this, it is important that you are kept up to date on the progress of the legislation after the consultation period ending October 2nd.